You open a financial blog or scroll through a newsletter, and almost everything you read feels familiar. Save more, invest early, diversify, and avoid debt. But what if I told you that even if you follow this advice to the letter, hidden forces in the economy could still derail your path to financial security without you ever noticing? These aren't conspiracies or secrets. They're the subtle mechanics of how money really moves in our system. Today, we dive deep into why most financial advice overlooks these invisible levers, leaving even the most diligent Americans feeling stuck in a cycle of stress and unexpected setbacks. Buckle up for an analytical journey through behavioral economics, historical patterns, and mathematical realities that could change how you view your finances forever. At first glance, it seems paradoxical. Advice is abundant. Podcasts, books, apps, and influencers bombard us with tips on building wealth. Data from sources like the Federal Reserve or Vanguard is just a click away. Yet, for millions of Americans, financial stress persists. Unexpected bills pile up, retirement savings feel inadequate, and market swings wipe out gains. Why does this happen? The core issue is the gap between surface level recommendations and a true systemic understanding. Conventional advice zeroes in on individual actions, what you can control, like budgeting or picking stocks, while glossing over the broader financial ecosystem. Economic traps, hidden wealth thresholds, nuanced taxation, market frictions, and deep seated behavioral tendencies all lurk beneath the surface, quietly shaping your outcomes. Without grasping these hidden mechanics, even the best intentioned plans can foster a false sense of security, making disciplined savers vulnerable to forces they never saw coming. Let's start by unpacking the psychological side of this equation. Humans are hardwired to simplify chaos, a survival trait from our evolutionary past. When financial gurus lay out a straightforward path, save 15 to 20% of your income, invest in low cost index funds, steer clear of high interest debt, our brains latch onto it as a complete solution. It's actionable, measurable, and gives a sense of control in an unpredictable world. But the economy isn't a straight line. It's a web of nonlinear interactions. Income growth doesn't happen in a vacuum. It collides with inflation rates that erode purchasing power, tax brackets that bite harder as you earn more, and interest rate cycles that can turn borrowing from affordable to burdensome overnight. Behavioral economics, drawing from pioneers like Richard Thaler, reveals that we chronically underestimate these compounding systemic forces while overestimating our personal agency. This cognitive mismatch creates a chasm. You put in the effort, follow the rules, but outcomes fall short, leading to frustration and self doubt. For instance, studies from the National Bureau of Economic Research show that Americans who adhere strictly to budgeting apps still report high financial anxiety levels, often because invisible factors like regional cost of living spikes in cities like New York or San Francisco quietly sabotage their progress. To make this concrete, let's examine wealth thresholds, a concept rarely highlighted in mainstream advice. Standard guidance assumes a smooth, proportional climb. Earn more, save more, and watch your net worth grow steadily. In reality, the US financial system is riddled with invisible thresholds that act like speed bumps, altering the trajectory of your wealth in subtle ways. Crossing an income bracket, say from $100,000 to $150,000, might trigger entry into a higher federal tax bracket from 22% to 24% marginal rate. Phase out eligibility for credits like the Earned Income Tax Credit or Roth IRA contributions, or expose you to the alternative minimum tax. These aren't just minor deductions. They can reduce the net benefit of a raise by 30 to 50%. Add in lifestyle inflation pressures, where social norms in affluent suburbs push for bigger homes or private schools, and that progress evaporates. For example, a $10,000 raise for a family in California might look great on paper, but after higher state taxes up to 9.3%, increased property taxes on a potential home upgrade, and childcare costs averaging $15,000 annually per child, the actual boost to your disposable income could be as low as $2,000 to $3,000. Conventional advice seldom models these subtleties, so people cross these thresholds blindly, wondering why their savings rate stalls despite earning more. Diving into the mathematics exposes even more gaps in typical guidance. Take a mid career professional in the US earning $120,000 annually following the popular 50-30-20 budgeting rule: 50% on needs, 30% on wants, 20% on savings and debt repayment. On the surface, that means socking away $24,000 a year. Invest it in a diversified S&P 500 index fund with an assumed 7% annual return after inflation, and compound interest projections look promising. After 20 years, you'd have around $1 million per basic calculators on sites like investor.gov. But hidden economic mechanics throw wrenches into this equation. Rising healthcare costs, averaging 5 to 7% annual increases per Kaiser Family Foundation data, could shave $2,000 to $4,000 off that savings bucket. Regional cost of living adjustments in high demand areas like Austin or Seattle might inflate housing from 30% to 40% of income. Then there's tax drag. If your investments are in a taxable brokerage account, capital gains taxes at 15% could reduce effective returns to 5 to 6%. Factor in sequence of return risk, where early market downturns, like the 2008 crash or 2022 bear market, hit just as you're ramping up contributions, and your nest egg might end up 20 to 30% smaller than projected. Mathematically, this can be modeled as future value equals P times open parenthesis 1 plus R minus T minus I close parenthesis to the power of N, where P is principal, R is return, T is tax drag, I is inflation/invisible cost, and N is years. The math underscores that systemic factors don't just nibble at edges, they silently reshape the entire trajectory, turning guaranteed growth into probabilistic outcomes. Behavioral mechanics add another layer of complexity, often underestimated in advice columns. We're not robots optimizing spreadsheets. We're humans swayed by cognitive biases, social pressures, and emotional rewards. The directive to save more presupposes ironclad self-control, but neuroscience tells us the brain's reward system prioritizes immediate gratification. That dopamine hit from a weekend getaway over delayed benefits like a fatter 401k. Social comparisons amplify this. In a culture where Instagram flaunts luxury vacations and LinkedIn highlights promotions, peer pressure nudges spending upward. Investment choices, they're tainted by fear, selling low during dips, and greed, chasing hot stocks like meme coins. Hidden mechanics exploit these flaws. Management fees on mutual funds, averaging 0.5 to 1% annually, compound to eat 20% of long-term returns. Per Vanguard studies, inflation quietly devalues cash holdings. Complex tax rules like wash sale prohibitions trip up DIY investors. The result? A misalignment where actions don't yield expected results. Behavioral economists like Dan Ariely point out that this isn't laziness. It's the system interacting with our wiring, creating feedback loops that standard advice rarely addresses. Historical parallels drive home how timeless this oversight is. Look back to the Roaring Twenties. Financial advice boiled down to buy blue chip stocks on margin amid booming markets. It ignored structural vulnerabilities like over-leveraged banks and speculative bubbles, culminating in the 1929 Wall Street crash that wiped out trillions in today's dollars. Fast forward to the 2000s, conventional wisdom pushed homeownership as the ultimate wealth builder with tips like get a fixed rate mortgage and build equity. Yet, it overlooked systemic mortgage risks, subprime lending, credit default swaps, and housing market overinflation, leading to the 2008 Great Recession, where millions of Americans lost homes and savings. Even in the 1970s stagflation era, advice to save in bonds failed against double-digit inflation and oil shocks. These eras echo today's challenges. Post-pandemic advice emphasizes diversify into tech stocks, but ignores hidden mechanics like Federal Reserve rate hikes, supply chain disruptions, and geopolitical tensions affecting energy prices. By studying these patterns as documented in works like A Random Walk Down Wall Street by Burton Malkiel, we see that advice detached from economic forces is brittle, effective in calm waters but fragile when hidden currents surge. Zooming out systemically, the U.S. economy resembles a vast, interconnected machine with subsystems like monetary policy, Fed decisions on rates, fiscal policy, government spending and taxes, labor markets, wage stagnation versus productivity, asset valuation, stock bubbles from quantitative easing, and consumer behavior loops, debt-fueled spending. Conventional advice isolates you from this machine, framing money as a personal puzzle solved by discipline and rules. But real outcomes emerge from the whole system. A Fed rate cut might boost stocks but inflate housing. Tax reforms like the 2017 TCJA could lower corporate rates while phasing out deductions for individuals. Network effects compound this. Your investment returns tie into global supply chains, where a chip shortage in Taiwan ripples to U.S. auto prices. Feedback loops like rising inequality driving policy shifts continually reshape the landscape. Ignoring these is why even meticulous planners face surprises, as seen in the 2020 COVID market crash, followed by a rapid rebound that favored those with systemic awareness. Let's explore a concrete taxation example in depth. Financial guides often tout maxing out 401ks or IRAs for tax advantages sound in theory, but in practice, these interact with progressive brackets, 10 to 37% federal, benefit phase-outs, for example, child tax credit drops at $200,000 for singles, and capital gains timing, a high earner in Texas contributing $23,000 to a 401k might save on immediate taxes but shift into a bracket where over time pay nets less after deductions. Asset growth could trigger surtaxes like the 3.8% net investment income tax for incomes over $200,000. Property taxes in states like New Jersey average 2.47%, higher for appreciating homes, adding hidden liabilities. The advice, maximize contributions, misses these webs, proving why holistic, system-aware approaches matter. Market behavior offers another lens. Advice assumes efficient markets with steady returns, but reality involves liquidity cycles. For example, post-2008 quantitative easing flooding cash, Fed policies swinging rates, and behavioral herds creating boom/bust. The 2022 inflation surge, peaking at 9.1%, eroded bond values while stocks tumbled 20%. Disciplined investors faced drawdowns, sequence risk, bad timing of withdrawals, could have retirement funds per Morningstar simulations. Grasping these transforms, investing, incorporate risk management like dollar cost averaging, contextual cues from economic indicators, for example, yield curve inversions signaling recessions, and timing around cycles. This requires a subtle identity shift. View shortfalls not as personal failings but as structural realities. Stress isn't always from poor discipline, it's from navigating complexity with partial maps. A systems perspective lets you assess decisions against hidden forces governing money flows. Practically, model thresholds with tools like TurboTax simulators for tax impacts, integrate biases via apps tracking spending triggers, anticipate shifts by following Fed minutes or CPI reports. These foster clarity, emphasizing education over illusions. In closing, most financial advice is a solid foundation, but it's incomplete without hidden mechanics. By dissecting psychology, taxes, cycles, and thresholds, you bridge why efforts misalign with results. This doesn't guarantee riches or erase worries. It equips strategic navigation. True mastery lies in seeing the unseen, turning reactivity into deliberate action. As you close that blog tab, remember, in America's dynamic economy, knowledge of these mechanics isn't just power, it's the key to financial resilience. Thanks for joining this deep dive. Reflect on one hidden force in your finances today, and let's build a more informed tomorrow.